Of all the wealthy individuals that I know, they've all become wealthy through business, real estate, and investment. And what I find to be very fascinating is how these wealthy families and individuals pay their kids, or at least how they pay for the kids' stuff. I'm talking about soccer practices, ballet lessons, piano lessons, and cart full of groceries. If you have boys, you know what I'm talking about. And I also found it to be very interesting and fascinating how the wealthy set up their estate to ultimately pass their generational wealth to the next generation to avoid taxes, or at least to pay as least amount as possible with taxes. And with the relationships that I have with some of these wealthy families, without mentioning any names, I'm going to share with you some secrets and underground strategies that these wealthy families are using to pay their kids to ultimately pay less taxes and keep more wealth in their pocket. Oh, and yes, you could definitely use these strategies like these wealthy individuals without being one. All right, the first fascinating part is how the wealthy pays their kids, especially if they're under the age of 18. And just to reiterate, kids are expensive, and I got one too, so you guys all know how that works. But paying kids, this is where it gets kind of interesting when it comes to taxes. Now, what 99% of people do is they pay for their kids' stuff, groceries, food, toys, you name it, after the fact that they pay taxes. And I'm talking about federal, state, FICA, you name it. But what I've seen the wealthy do is very interesting, is they're able to pay their kids pre-tax. I want to show you how. So I mentioned that most wealthy individuals that I know became so through real estate, investments, business. They have business income other than just W-2. What these wealthy individuals are able to do is they're able to pay their kids as a tax write-off, a tax deduction to lower their taxable income. So I'll give you a real life example of me applying this. So this is a couple years ago. My daughter is about 2 or 3 years old, and as you can imagine, a lot of 2, 3-year-old daughters are very cute, adorable, and beautiful. And I needed to figure out how to make this a tax write-off. So here's what I did. In one of my YouTube videos, what I've done is I needed to make a video that had to have a 2 or 3-year-old Asian baby girl to make it relevant and to make it actually work. Now, obviously, where do I get a 2 or 3-year-old Asian baby girl? Oh, that's right, my daughter. So what I did is I brought my beautiful stick figure, there we go. She's happy, into my YouTube video, and because she appeared on my YouTube video, she charges an appearance fee like any other YouTube channel. In fact, I paid another YouTuber almost 10 grand to show up in my YouTube channel. So yeah, it happens quite a bit. So what I've done is I brought my daughter to appear in my YouTube video, and she charged $6,000 per video to make an appearance, and she appeared on 2 videos for me. Now, why that number? Why is that important? Because total, I paid my daughter $12,000 to appear in 2 videos. Now, at the time, the standard deduction was about $12,350 for that year. So here's what I did. I paid my daughter $12,000, not directly from my business. Here's what I had to do. My YouTube channel is part of a bigger business. This business paid, at the time, my family management company. And the reason why I had set up a family management company is because my tax professional advised me to do so. Again, if you speak to your tax professional about it, this situation may look radically different for a lot of different people. At least for my personal situation, I had set up a family management company, which is a sole proprietorship, separate bank account. My wife runs that. She's the manager of the family management company. And this family management company then ultimately paid my daughter 12 grand. There was a physical transfer of that money from my business to the family management company as outside service. There was a contract, invoice, the whole 9 yards. Made it very official, documented everything. In case we need to prove this relationship, we have the contract and invoice to make that happen. So my business pays my family management company $12,000. The family management company pays my daughter $12,000. And what's great is that because my daughter is less than 18 years old, she does not have to file taxes on her earnings. Plus, it's within the standard deduction, which means that she doesn't have to pay taxes. Which means on my business side, I can claim $12,000 as a business write-off, legitimate business write-off for outside services. My family management company pays my daughter $12,000, and next time we gotta go pay for toys, diapers, groceries, ballet lessons, gymnastic lessons, you name it. Am I paying it out of my own pocket? No. My daughter, who now has a checking account, is paying for her own groceries, right, or toys, snacks, diapers, you name it, all the expenses that are associated to raising a 2 or 3-year-old, right? But what's even more exciting is that I was able to fund a cash value permanent life insurance for her, which her premium is super duper cheap, right? So I got life insurance, for her. I could even set up 401k, retirement, right? I can set up all these different accounts because now I'm paying her money, and now she's got an asset that she's building up over time on top of paying for her own personal groceries. So what I just did there is that assuming I'm at a 30% tax bracket, I saved $4,000. I'm gonna use red for this. I basically saved $4,000 of taxes that year because I was able to reduce my taxable income on my business by $12,000, kept it within my family, paid for all the personal stuff that my daughter's got going, even funded some of her financial assets, retirement, and so on, and ultimately got myself a $4,000 tax discount. That $4,000 that I would have paid to the IRS for God knows what, missiles and, whatever funding to North Korea, now we can use that towards more investment, to other personal expenses we have, to save more aggressively, to get into real estate, which I love, to talk about in our channel. That is one thing that I see time and time again, the wealthy do very, very well. In fact, outside of my own personal example, I have friends that also run businesses, very successful, and what they have is they have their kids come clean the office for set amount of reasonable compensation, and they do it the exact same way. Now their kids are actually helping mommy and daddy run their business, learning the value of hard work, and truly earning, Xbox they want to buy, Roblox gift cards, right? Video games that they want to play, all under the guise of saving money on taxes. That is how the wealthy do it. This is how the wealthy is able to pay less and less tax, keep more money, maintain the generational wealth. And I know this doesn't seem like a lot. You do this for a decade, let's say assuming the same $4,000 of taxes for 10 years, that's $40,000 of taxes that you would have given to the IRS, and they're gonna use it however they wanna like it. And that $40,000 is in our pocket and I'm able to use it to secure our financial future. That, my friend, is the difference. Now, obviously, that's just one child. If you have 3, 4 kids, right, you now have $4,000 times 3 or 4, whatever the case might be. Again, this was many years ago. The new standard deduction, at least for this year in 2024, is about $14,000. So you can pay your kids up to $14,000, write it off, and therefore, if you're at, again, 30% tax bracket, you're probably saving close to about $4,500, $5,000 on taxes per child. Incredible, okay? So that's paying kids, and I see the wealthy do this very well. Again, there's many different ways to quote unquote skin the cat. Talk to your tax professional, talk to your tax attorneys. They will set this up properly. Again, you gotta have a business income, and your kids actually have to perform some kind of service. There has to be exchange of value. So you can't just pay your kids for no reason. They actually have to do some work for you, whether it's cleaning, shredding paper for you. In my case, I had my daughter show up on our YouTube video, which by the way, it's in our YouTube channel, so you can go look it up. So there's several ways that you can engage your family to what you're doing as a business, to work. I have friends that own rentals and they have their kids come out and mow the lawn at the rental property. Landscaping service, hello, right? So you can pay them for that. So there's so many different ways to do this. Make sure you talk to your CPA and tax professional about it. Next is, how do the wealthy keep the wealth within their family after they pass away? Now, if you weren't aware of this already, there's something called an estate tax. Now, most people don't pay this, but the wealthy do. For at least this year, it gets triggered if you have a net worth of at least, I believe, 13 or 12 million. In 2025, it's expected to go down to $7 million in terms of net worth. Now, what an estate tax even is, it's a tax that you pay as part of transferring your wealth and your assets over to your heir, your next generation. And again, it only gets triggered at a certain net worth amount. And in handful of states, there are also inheritance tax that you pay as part of passing or transferring wealth to the next generation. So it varies, at least at the federal level. Right now, it's at about 12 million in net worth. It goes into 7 million in 2025, but different states have their own estate tax system. But this is how the wealthy avoid paying much of the estate tax or the inheritance tax in given states. And yes, we can get into the conversation about how they incorporate different trusts and LLCs and corporations. It gets pretty robust. And they structure these different types of entities and pretty complex tax strategies based on different lifestyle needs as well as financial strategy. But there is one thing that I see as a common denominator time and time again in almost every wealth strategies that I've seen is life insurance. So life insurance is definitely one of many tools that the wealthy uses to not only store their wealth, but also transfer the wealth to the next generation tax-free. Now, for this segment, I have my good friend and an expert, Caleb Gilliams, to break down how do the wealthy treat life insurance when it comes to storing and preserving their wealth. All right, buddy, so I have my good friend, Caleb Gilliams here, who I deem to be is an expert in the insurance and wealth management space. Caleb, how does a life insurance play a role when it comes to the top 1% wealthy individuals preserving their wealth within a family environment?
Yeah, I love this question. I wrote the book, The And Asset, around this very exciting topic of life insurance. And it's very much because when the wealthy especially don't look at life insurance as an investment, they look at it as a place to storehouse, protect, grow, use, and pass on their money in tax-advantaged ways. And I'm going to do my best to explain all of that. So life insurance is essentially a contract with an insurance company, and you can set up that contract to be very tax advantaged and really off the radar screen of what a lot of people would even have to require you to count assets. And so a lot of people love that it's more private contract. And when your money is in your life insurance policy, it grows tax deferred. You can use it tax free when set up and used properly. But then one of the things that we're talking about is ultimately you can use it as an asset. And then the moment that you pass away, it gets passed on income tax free. And so if the super wealthy utilize trust as well from a standpoint to save on estate taxes, but in a lot of cases, depending on who the president is, what the law is, the estate tax is high enough where the ordinary person doesn't have to worry about it. And obviously the super wealthy use trust on top of that, but they use life insurance as like a family bank that knows that every generation is going to get more money because of how the death benefit is set up.
Yeah. So how does that work? So let's say I'm the wealthy individual. What am I contributing, or how would I set up something like this so that when I pass away, my next generation is starting out at a wealthier place?
Yeah. There's two types of way people view life insurance. I would say the ordinary person views it as like a term insurance policy. They want to buy term and invest the difference. And the whole idea is when you're hit 55, 60 years old, you don't have any more term insurance premiums. It's a pure expense and your assets are at a place. The wealthy don't look at it as an investment. They look at it as a place to store, protect, use their money. And so they're putting in they're essentially saving money and looking at it very much like a savings account where, again, they get access to almost all their money early on. They can utilize it. But the benefit is you have your cash value, and then to make it all tax-free, you need a death benefit on top of it, because one of the best loopholes in the tax system is life insurance is non-taxable because no one wants to tax the widow who's getting their life insurance policy. But the beautiful thing is if it's all in tax advantaged, then your cash can build up in a tax advantage way, but then your death benefit has to continue to increase because to making it all tax free. And so the short story is the wealthy look at it first and foremost as a place to store, use, and protect money. And as they continue to save money, it's more efficient than their savings account. But the benefit on top of that is their death benefit grows every single year. And so it's not uncommon to have millions of dollars of cash value that you can use throughout your life and have multiple millions on top of that of income-free tax death benefit that gets passed on. So that's very much the difference between the term expense versus looking at the permanent more as an asset, long-term savings vehicle that ultimately multiplies your money tax advantage when you pass away.
Right. So if I'm hearing you right, the death benefit grows, and that when that death benefit gets paid out to the beneficiary, the entire amount is tax-free. Is that right?
Yeah, it's income tax-free. And so if you're over, like right now, if you're over the $12 million, it could trigger some estate tax, but it comes income tax-free and it through probate. So it doesn't necessarily can pass through probate. So for a lot of people, it's the fastest, easiest money that you get, and you don't have to wait and do all these hoops that you get the money. But yes, it's income tax free. And then if you are super, super wealthy and you're thinking, oh man, I could trigger some estate taxes. I'm going to have well over 12 million if you're single or well over 20 million if you're married. Then you would want to work with someone in addition to help you set up some type of trust that the death benefit would go into. And then there could be some other strategies that you could use to make sure that you don't have to pay the estate tax.
Yeah, for sure. So what else that I have not asked or brought up in the space of life insurance that the wealthy understand and used for wealth preservation within their family.
Yeah, I think the biggest epiphany is a lot of people on TikTok and YouTube want to overpitch life insurance as an investment. Right. And Sam, you and I both know that there's way better investments that you can make. Right. But the wealthy, again, understand it more as a savings vehicle. And if you understand that, you know, after year 2 or 3, every dollar that you put into life insurance, and we're talking about whole life insurance. So this is not even just a speculation. This is more like pretty rock solid. Any dollar you put into whole life insurance after year 1 or 2, you know, gives you more of that back and available. So a lot of people look at this as like, why would I not put a significant savings into it? And if I'm an entrepreneur, if I'm a real estate investor, I could use that as an asset to leverage and do other things, but I have like a really solid foundation. That's the thing that we've been seeing. And it's fun that we see parents put it on their children. And we call this the Rockefeller method, because if your grandparents, parents, children and grandchildren all have it, it's ultimately when every generation passes away, it can backfill into the other policies. And every generation ultimately can use their money throughout their life, knowing that when death happens, which is an essential guarantee, that money will get passed on. And so it again allows you to use money to lean into your intentional life today, with also making sure that you're maximizing the future, all in a very private tax advantage space. The last example I'll use is a lot of people still love the idea of college. I mean, I think you and I could have conversations. Is it worth it? Is it not? Right. The reality is, if your money is in life insurance, you don't have to use that as an asset. Like, you don't have to disclose that as an asset. And so it's technically like, that's an example of, the reason I call this the and asset is there's so many benefits of putting it into life insurance. And there's examples of people that are able to put their money and they get so many benefits, like not having to disclose it in certain areas, a death benefit, certain chronic illness riders that act very much like a long-term care. There's so many of those things. And so the wealthy understand, I want to maximize each dollar to the best.
Yeah. So there's tax advantages, privacy advantages. You can cascade it down to your next generation. I know you touched on a little bit of an advanced strategy using trust to also further mitigate some tax liability. So Caleb, I think this was a great summary of what's possible. And obviously, if you want to learn more, you can reach out to Caleb, but he's also got a YouTube channel as well, where you can learn more about how life insurance plays a role in the life of a wealthy, how it's used as an advantage. So Caleb, thank you so much for your insights, man. And the point that I'm really highlighting in this video is that it's not just about sharing the 2 things that I just shared. It's about, okay, what other areas? I want you guys to start asking questions and be in this discovery mode of, what can I do better with my finance? What can I do right now to optimize, whether it's my taxes or wealth or my estate, or it could be about, hey, I want to start a business or get involved into a business or invest in one, so that I can also play in this game of wealth creation and keeping the wealth as much as possible. I want you to start thinking in that mode of checking out some of the other videos, right? Not just our own YouTube channel. There are phenomenal videos out there on YouTube that will start to expose you to different types of strategies, different creative ways, things that you didn't even know about when it comes to money. So I want you guys to check out those videos, as well as we have more videos here about how to get into real estate, how to save money on taxes, how to save money on mortgage interest. Our channel is dedicated to helping you save money, make money, and keep more of it. And stick around, subscribe if you're new. We want to continue to be here for you in your journey of creating financial freedom and financial peace of mind. So with that being said, definitely stick around, leave your comments down below, subscribe to your channel, and check out this video as the next segue.